Hey guys, welcome back to the channel. Next year, I'm potentially looking to buy my first home. So recently, I've been doing a lot of research on the home buying process. And a very common question that people have is which is better, a 15-year fixed rate mortgage or a 30-year fixed rate mortgage? In this video, we're going to cover the pros and cons, and I'm going to break down the math exactly what it's costing you for each one of these. And if you talk to certain financial advisors, they are very adamant that either the 30-year is better or the 15-year is better. People like Dave Ramsey will say all debt is bad and a 15-year mortgage will get you out of debt faster. That's one of the main reasons why they advocate it. So what are the pros? What are the pros of the 15-year rate mortgage? Well, historically, they've always had a lower interest rates. If you qualify for the 15-year mortgage, then banks actually view you as less risky and they're more likely to give you a more favorable loan. If, for example, you go on Chase's website for a 30-year fixed rate, they're doing 2.5%, and for a 15-year fixed rate, it's actually 2%. If you're watching this video far in the future, interest rates are at an all-time low, so everybody is getting really good deals on their mortgage rates right now. So the difference between these two is traditionally between 0.25% and 0.75% for the loan amount. Additionally, if it's only a 15-year period, you're paying off your loan faster, which means you're building home equity faster, which means over the lifetime of the loan, you're paying less money in interest to a bank. And that's pretty much it for the 15-year loan. You have a lower interest rate and you pay off the loan faster. That's pretty good, right? Well, let's actually do a comparison and do a deep dive into these two kinds of mortgages. So for our numbers, we're going to do the exact same house worth $300,000. And for the 15-year rate, let's say 2.25%. For the 30-year rate, 2.75%. When we enter the 15-year mortgage into a calculator, $300,000, 2.25%, your monthly payment is going to be $1,965. And over the lifetime of the loan, you're going to pay $353,746. That means in total interest, you will have paid $53,746. So immediately when you look at that loan, that monthly payment might seem kind of high to you. That might be a lot for your household income. So let's go ahead and compare it now to the 30-year mortgage, and we'll input the numbers. This time, the higher interest rate of 2.75%, your monthly payment is going to be $1,225. The total cost of the mortgage over the lifetime of the loan, $440,900, so you paid $140,900 in interest. Now for a 30-year fixed rate mortgage, that mortgage amount of $1,225 looks much more manageable for the average family. What is the difference? It is $740 a month. So the 30-year fixed rate mortgage, you're paying $740 less a month. However, how much more in interest over the lifetime of the loan are you paying? And it's $87,154. Now, first thing I want to say about that $87,154 is that in future dollars, it's not going to be worth as much. Because inflation is 2% a year, it doesn't matter what your home is appreciating at. What is the purchasing power of $87,000 in 30 years? Well, in the year 2050, in today's purchasing power, it's probably worth less than $40,000. So you do have to remember that over time, what it's costing you is actually less in today's dollars because of inflation. But what if you get the 30-year fixed rate mortgage and you just treat it like a 15-year fixed rate mortgage? There's nothing stopping you from ever paying down your mortgage early. So when you're at the bank and you sign the paperwork, you could just get the 30-year fixed rate mortgage and then your minimum payment is $1,225. However, you just decide on your own to increase that. You're going to pay $1,965 a month. The difference between doing this is then the interest rate. Well, we're assuming a difference of 0.5%. And the reason you would do this is to minimize your risk. There's no risk in just getting the lower minimum payment mortgage. So what if in 10 years there's a housing crash? What if in 10 years you lose your job? If you took the 15-year fixed rate mortgage and then all of a sudden you're out of work and you can't sell your home because the market has crashed again. What happens to your home if you can't make your mortgage payments? You lose it. And there are people that do this. There are people who want to pay down their mortgage sooner, but in order to minimize their risk, to hedge against the uncertainty of the future, they deliberately get a 30-year fixed rate mortgage, and then they just decide to start paying down the mortgage earlier by increasing their payments. Yes, you have to deal with the difference in rates, but what is that actually costing you? Well, if you just put it into the mortgage calculator, instead of 2.25%, it's 2.75%. Over 15 years, your monthly payment would then have to be $2,036, and the cost of the mortgage would be $66,456. So you can think of this as the 15-year fixed rate mortgage and the flexible 15-year fixed rate mortgage. If you want to reduce your payments to the 30-year fixed rate amount, you can do that if you experience any kind of financial hardship. You are accepting that slightly higher rate, and what is that costing you? Well, it's costing you $71 a month. Over the lifetime of the loan, over 15 years, it's costing you an extra $12,710. And really, I view that $12,710 as an insurance policy. You're going to be buying insurance on your home anyways for, whatever. So the ability to reduce your payments whenever you need to and not risk losing your home should there be a crash or you lose your job, for a 15-year period, paying $71 a month for that guarantee, it's worth it to me, in my opinion, it's worth it to me to pay that higher interest rate and have that flexibility. So we covered the risk associated with the 15-year mortgage, but what about this difference? There's a substantial gap in money occurring here between your monthly payments of $1,965 and $1,225. What are you doing with this extra $740 a month? Where should that money be going if you got the 30-year fixed rate mortgage? And people will tell you that you should be investing. What if you had invested that difference in your mortgage payments? And on my channel, I always recommend people just buy simple, low-cost S&P 500 index funds. You can Google what is the long-term average of an S&P 500 index fund with dividends and capital gains reinvested. The long-term average is 9.8%. Yes, there is volatility in this index. Some years it's up 30%, some years it's down 30%. But when investing on a 10, 20, 30-year time period like you would be doing in this difference amount for our mortgages, the long-term average you can expect is 9.8% a year. If you're looking for private banks to partner with, I always recommend either Vanguard, Fidelity, or Schwab. These are the mutual fund and ETF equivalents. You can Google these symbols to learn more about these funds, or you can watch more videos on my channel. So let's now reconsider the math of a 15-year fixed rate mortgage and a 30-year fixed rate mortgage, assuming that we're investing $740 a month in index funds. What does the math look like now? $740 a month is $8,800 a year for 15 years at an interest rate of 9.8%. This will give you $304,920. This is actually more than what your house is worth if you had been investing consistently this amount of money every month for 15 years. However, what is it over a 30-year period? Let's say you're putting in $740 a month for 30 years at 9.8%, this would get you over $1.5 million. Now hold on a second, I know what you're thinking. Well, Jake, I'm gonna, focus on my mortgage for the first 15 years. I'm gonna pay this down. Then the next 15 years, I'm gonna put all $1,965 completely at index fund investing, either a taxable brokerage account or my 401k IRA. So I will eventually overtake the 30-year fixed rate mortgage guy who's paying all this interest, right? So let's do the math. You're contributing $0 a month in comparison to the 30-year fixed rate person for 15 years. Then after 15 years, you've paid off your mortgage. You're then going to put $1,965 a month into index funds. That's $23,580 a year. So year 16 through year 30, you're investing heavily in the exact same funds, 9.8%. You would have $809,000. However, the math doesn't add up. When you factor in the value of the home, and we're not factoring in how much the home appreciated, those two factors are constant. Any other kind of investing you did on the side, that's all constant as well. So interest paid to the bank for a 15-year mortgage, 15-year investing, $53,746. You made $810,000 investing. You'd have $1,056,000. However, what if you're doing the 30-year fixed rate mortgage while simultaneously investing that difference in money for 30 years? Once again, $300,000 home, you paid $140,000 in interest. However, in your investing, you made $1.5 million. So the difference between these two scenarios, $1 million versus $1.7 million. And what I just demonstrated to you is the power of leveraging money when debt is only costing you 2.25% or 2.75%, and instead you use that money to earn money at 9.8%. Whatever the difference between those two numbers, that's what you're gaining on the 15-year fixed rate mortgage person. So this is a philosophical debate between these two. It's not a numbers one. The math here is pretty simple. Doing the 30-year fixed rate mortgage and investing the difference for 30 years will yield you much more money. But people who go for the 15-year fixed rate mortgage will say there is the comfort and security that I'm getting out of debt faster, that I will own my home sooner outright. That to me has a monetary value, but once again, if you run the numbers, it's not even close. There you have it, guys. That is the difference between the 30-year fixed rate mortgage and the 15-year fixed rate mortgage. If you know a friend looking to buy a home soon and they're confused by this process, feel free to share this video with them. Also, be sure to give me a thumbs up so the algorithm knows it's good. If you haven't subscribed to my channel, consider subscribing. I talk a lot about finance and investing issues. If you have any comments or questions, or you know something I don't, or I made a mistake in this video, leave me one down below. I love hearing from you guys. Till the next video, take care.